Welcome back. For today's Business Matters, we have Don Ma here with us. Don, good to see you. What's happening?
Good to see you as well. So update from Japan, actually. So this is what's happening here. Traders in Tokyo have been benched from watching the World Series. So Game 5 of the Dodgers versus the Yankees is tonight. Major League Baseball and Fox Sports estimate that 12% of Japan's population tuned in to watch superstar Shohei Ohtani's World Series debut, but traders are excluded from that group. According to Bloomberg, an employee of Deutsche Bank told them that TVs on the company's trading floor in Tokyo are strictly for financial news channels. Traders are also not allowed to watch from their mobile devices in real time. The rule is largely for compliance reasons to prevent leaks or unapproved deals. Meanwhile, a popular weight loss drug maker has shed nearly $70 billion in market value, and this is in response to Eli Lilly's falling short of Wall Street sales estimates. The company ramped up production last quarter over outsized demand of its high-profile weight loss drug Zepbound and diabetes treatment Mounjaro. This was to fill back orders to wholesalers for both drugs. Now supplies are sitting in warehouses. CEO David Ricks told investors the sales miss was partially from wholesaler customers limiting stock due to financial and physical constraints since the drugs require refrigeration. An AI server maker Supermicro has lost its auditor and more than 30% of the shares in just one day. Supermicro revealed today that Ernst & Young has resigned as its auditor. The company has been dealing with issues over internal financial reporting. Supermicro says EY raised concerns this summer about its transparency and governance. Following an investigation, EY decided to resign after receiving additional information in the review process. Supermicro said it disagreed with the accounting firm's decision and does not expect this to impact its quarterly reports for fiscal 2024. Now, billionaire investor John Paulson is considered a top candidate for Treasury Secretary in possible Trump administration. He tells the Wall Street Journal that what he would do in the job, including massive spending cuts, tax cuts, and a team up with Elon Musk. Here's the story.
Billionaire investor John Paulson is said to be a top contender for Treasury Secretary under a Trump presidency. Paulson told the Wall Street Journal he would work with Elon Musk to slash federal spending, extend Trump's 2017 tax cuts, and get rid of the renewable energy subsidies in the Inflation Reduction Act. He says all of these tax subsidies for solar, for wind, inefficient, uneconomic energy sources eliminate that. That brings down spending. Paulson says he also wants to encourage more energy production and says tariff threats can be a negotiating tactic.
We live in a very unfair world where we have almost no barriers, foreigners selling here, and we face lots of tariff and non-tariff barriers exporting abroad. And that's left to devastation in many of the communities across the U.S.
Paulson told Fox News in September that tariffs are the way to fix that. The 68-year-old investor was born in Queens, New York. He attended Harvard Business School and later founded his own hedge fund.
Paulson & Co. is an investment advisory firm that was founded in 1994. We currently manage assets of approximately $36 billion using event-driven strategies.
At the fund, Paulson became famous for betting against the 2008 housing market, what some call the greatest trade ever. Paulson & Co. made $20 billion. Paulson has also been a significant Republican donor. He's contributed to all three of Trump's election campaigns and has hosted fundraising events for the former president.
Now, some good news for the economy. The GDP grew at a robust annualized rate of 2.8%, and the figure was slightly lower than economists had expected, but continues to dispel concerns that the economy may be slowing down. This latest report is the last major piece of economic data before the November election. According to the Bureau of Economic Analysis, the growth was boosted by a surge in consumer spending and a pickup in exports and strong federal government spending. The new data comes weeks after the Federal Reserve cut its benchmark interest rate by 0.5 percentage point. Now, a warning for drivers. Staged car accidents are on the rise. It's becoming a significant issue in California, New York, and Florida. Data from the Insurance Information Institute indicates that California had the highest number of staged accidents reported last year, roughly 5,300 cases. One insurance expert says that in some cases, scammers recruit unscrupulous medical and legal professionals to sue the drivers. The expert adds that these staged accidents are raising insurance premiums for U.S. drivers as much as $300 a year and costing the insurance industry roughly $20 billion a year. And Ford is falling behind while rival General Motors is racing ahead. Ford stock has tumbled about 8% so far this week. The company's effort to improve efficiency in its traditional gas engine operations is sputtering. CEO Jim Farley noted that the company is being dragged down by quality and warranty problems, supplier issues as well, and waste. Excuses some Wall Street investors feel that they have been hearing for years now. Ford cited isolated events too, like recent hurricanes impacting the automaker's annual outlook. Some investors are also annoyed at Ford for preserving cash and paying a dividend instead of engaging in a stock buyback like GM, whose shares are up 43% this year. Volkswagen held a second round of talks today with union and employee representatives at its headquarters in Germany. Unions raised the prospect of strikes, actually, at Volkswagen unless the automaker rules out plant closures from its restructuring plan. The talks at Volkswagen's headquarters come as it reports a plunge in third-quarter profits. Management wants to close plants in Germany for the first time in the company's history. High costs and growing competition are weighing on Europe's biggest automaker. Labor leaders said they also plan to cut tens of thousands of jobs and reduce wages by at least 10%. Now, the EU has announced an increase of tariffs on Chinese electric vehicles. That's on top of the current 10% currently levied on car imports. Here are the details on the new tariffs that will go into effect today.
In a move sure to rile Beijing, the EU plans to raise tariffs on Chinese-made electric cars. The new duties will range from 7.8% for Tesla to over 35% for state-backed firm SAIC. That's on top of a standard 10% import levy. The extra tariffs were officially approved Tuesday and will take effect on Wednesday. The EU says the move is needed to counter China's unfair state support for its firms, including special loans and cheap materials. It says millions of extra Chinese EVs are likely headed to Europe otherwise, with the US and Canada having already imposed their own steep duties. The China Chamber of Commerce in the EU expressed deep disappointment over what it called an unfair measure and criticized slow progress on talks over the issue. Beijing has responded with investigations into EU brandy, dairy and pork, and has challenged the EU's actions at the World Trade Organization. European car makers are dealing with an influx of cheaper electric cars from China, which now hold 8% of the EU market, up from less than 1% in 2019. That could reach 15% by 2025, with prices for Chinese cars typically 20% lower than European-made vehicles. Some EU member states aren't happy with the EU move. Germany, the region's largest car maker, was among countries opposed, fearing its big auto exporters could face retaliation. The country's economy ministry has called for a diplomatic solution to reduce trade tensions and protect EU industry.
And staying in the EU, the Eurozone economy grew faster than expected last quarter, but was it enough to improve a weak outlook? Here's a closer look on that.
Official data showed Wednesday gross domestic product in the 20 countries sharing the euro grew by 0.4% from the previous 3 months. It beat expectations but still showed weakness as industry stayed in recession. Household consumption also barely grew. The bloc stayed on pace for full-year growth at or just under 1%. The biggest surprise in Wednesday's numbers came from Germany. Europe's largest economy grew by 0.2% on higher public and private consumption. That was despite officials predicting a recession given the struggles of its huge industrial sector. France and Spain also showed unexpected resilience, but the figures indicate the bloc is still behind the US, which reports annual growth figures Wednesday. On Tuesday, US presidential candidate Donald Trump threatened Europe will pay a big price if he wins. He's also promised to impose a 10% tariff on imports from all countries. Any new tariffs would likely lead to retaliation, raise costs, and lower global trade. US trade hostility would come on top of escalating tensions with China. The EU decided this week to raise tariffs on Chinese-built electric vehicles to as much as 45.3%. Looking ahead, markets have priced in another interest rate cut from the European Central Bank of 25 basis points in December.
Britain's government unveiled tax increases in borrowing worth some $94 billion per year as part of their first budget. The costs of the new taxes were largely borne by businesses, but they are expected to have a knock-on effect as well on workers and the national economic growth. NTD's international correspondent Malcolm Hudson has more for us from London.
This government was given a mandate to restore stability to our economy and to begin a decade of national renewal.
British Chancellor Rachel Reeves announced the UK's biggest tax increases since 1993 as part of the new Labour government's first budget. These will raise over $52 billion per year, much of this tax burden falling on businesses. This comes alongside $42 billion per year of increased borrowing. Reeves said working people will not see higher taxes in their payslips.
So I say to working people, I will not increase your national insurance, I will not increase your VAT, and I will not increase your income tax.
National insurance is a tax to fund the National Health Service, or NHS. Reeves didn't increase the employee contribution, but did increase employers' national insurance contribution and lower the threshold at which it needs to be paid, which will raise some $32 billion. Now, the Labour Party had promised not to raise taxes on working people during their election campaign, but this national insurance increase on businesses means it will be more expensive to employ people. The Institute for Fiscal Studies said this will hit businesses employing low-paid workers the hardest and will ultimately mean this tax increase will be paid for by working people. Reeves said this cash injection will bring hospital waiting lists down to a maximum of 18 weeks. The increased tax revenues will also be used in defence, schools and house building projects. The Office for Budget Responsibility warned the tax rises will weaken long-term growth. Other tax increases include changes to inheritance tax that would mean inherited pensions will be brought into the tax in 2027. Agricultural and business property relief will also be reformed. From April 2026, assets worth up to £1 million will not be taxed, but value above that level will be subject to a 20% tax. Many farmers are worried this means they will no longer be able to pass on their family farms to their children. Malcolm Hudson, NTD News, London.
Now, Starbucks is scrapping its controversial olive oil-infused drinks, and this is less than a year after they debuted nationwide. The lineup of Oleato drinks will be eliminated from Starbucks menus in the US and Canada beginning in early November. The Oleato lineup was former CEO Howard Schultz's idea. The beverages were met with largely negative responses from media and consumers. Now, listen up, parents. A major baby powder recall is growing. The Food and Drug Administration has expanded a recall of Dynacare brand baby powder made by the Dynarex Corporation. The recall expansion is due to recent tests that indicate the possible risk of asbestos. The FDA says the recall is now affecting products in 35 states, up from just 12 states in September. The company says it has stopped the distribution of the products and is investigating to determine what caused the contamination of the talc. And new Apple products. The iPhone maker has unveiled its new MacBook Pro models with updated M4 chips. The lineup features more powerful processors to attract creative professionals. With the rise in artificial intelligence tools, users have been looking to upgrade to laptops with more powerful chips. At the same time, the tech giant released its free Apple Intelligence software update. It can be accessed in most regions worldwide for Macs with M1 chips or later. The device and serial language needs to be set to US English. The new line of MacBook Pro laptops are available for pre-order and start at $1,600. All right, market. S&P 500 and NASDAQ closed lower today as chip stocks tumbled and investors await a host of corporate earnings. Microsoft and Meta Platforms are set to report results after the bell. The information technology sector was the biggest decliner here today. Meanwhile, a new report today showed that U.S. private payrolls growth surged by a higher than expected 233,000 jobs in October. And of course, the neck-and-neck race between U.S. presidential candidates Kamala Harris and Donald Trump continued to be at the top of investors' minds ahead of the November election. All right, that's all the stories I have for you guys on Business Matters. Back to you guys, Carrie, Fiona.
Thanks for that, Don. Coffee and olive oil. What could go wrong?
You know, it's interesting. I haven't heard about this at all. You know, if they had promoted it a little more, I would have gone to try it.
Well, I have heard about it, but now since that they're scrapping the idea, I think it's safe to say that in the beginning, I didn't even think it was a good idea. I mean, I don't even like a lot of oil in regular food. Adding that to coffee, I don't know. Doesn't sound like a perfect match for me.
Well, they should add you to their marketing team. Called it from the beginning, it seems.
I don't know. I feel like you drizzle a little olive oil and the magic happens. So I must be in the minority. So
maybe for salads.
There you go. We'll see you back here tomorrow,
Thanks,
Don.
Don.
Thank
All right.
you.